Celeste, Stop This Flame, winner of the Rising Star Award at the Brit Awards last night. And congratulations to her. Felix Milton's in the building. Morning.
Good morning.
How are you?
Very well. How are you?
Good. We haven't done this in a while.
We haven't. It's been a little while. I think this was the first one actually with you when I spoke about Christmas saving.
It was. We were trailblazers.
We were.
And now look at you. You're a regular fixture
There we go.
on the Voice calendar. Wonderful. What are we talking about today? Oh, I should introduce you, sorry. If you don't know who's talking at the moment, it's Felix Milton from, and I always get this wrong, so you might as well do it.
From Philip J. Milton and Company, and I'm a charter financial planner.
So posh, isn't it? How exciting. Right, go on then. What are we talking about today?
So today we're going to talk about savings because NS&I, which is the government savings body, so National Savings and Investments, has cut their interest rate.
And they're the people who do premium bonds.
They are the people that do premium bonds, and so that's affected quite a few people. 23 million in the UK have savings with them. So we're just talking a bit about why they've done it and where we're going to go from there.
Yeah, so let's start with the why. Why has this happened?
So the government, NS&I sort of set rates depending on what the Bank of England base rate is. And the idea with NS&I is your money is backed by the government. So regardless of what happens, the government won't go bust. They'll always bail you out. So NS&I are the people that offer premium bonds. And basically, they've decided that they're going to make it a bit less likely that you win because it costs them money, obviously, paying interest on it. And they've decided that they're going to cut the rates further just so it saves them some money, basically, and in line with the Bank of England base rate and so on.
So if you have premium bonds, you're now less likely to win in the premium bond lottery.
Yes, so premium bonds work on an expected return. So that means that sometimes you'll win and sometimes you won't. And a lot of people like premium bonds because they get £10 here and there. But actually, if they add up how much their winnings are over 5 years and compare it to what they would have got in the bank, even if it was, say, 1%, they probably would have got more in the bank.
Really?
So,
okay.
Because for premium bonds to work, for every winner, there is a loser.
Yes.
Or there are several losers. So that's basically, it's nice getting £10 or £20 every now and then, but really, they're not the best sort of investment.
So going forward then, if you have savings with the NSI, what should you do hearing this news? So
really what you need to do is go, firstly, why have you got savings with NS&I? So is there an actual need for your money to be backed by the government? Most banks and building societies get the Financial Services Compensation Scheme limit, which covers £85,000 of savings anyway. So if you've got under £85,000,
which does most people,
you may as well shop around and go for the bank that's going to pay you the highest interest rate. So that's the first thing I suggest is premium bonds are very nice. They send you money every now and then, but really, is that rate of return worth it for you? It's an expected return, and some years you may get a 0% interest rate, and even with the expected earning, it's a 1.15-ish% I think at the moment. That's an expected rate, so you're not guaranteed to get it. Whereas if you go to a building society or a bank and you're getting 1.15%, you're going to get that. They're going to pay it, so it's not expected.
So you said you've got to think about whether premium bonds are still right for you. In what circumstance would they still be the thing to go for? Premium
bonds really are you only really, in my opinion, want to have premium bonds if you're a very, very wealthy person. If you use every other allowance, then put your £50,000 into premium bonds because, hey, you might win £1 million, but you're not really going to win £1 million. Right. And also you may win something every now and then. So it's a last resort. If you don't have that much money, your chances of winning are quite small, and actually it's a bit of a lottery, and you may as well get a better return and search for the highest interest rate paying account, which varies almost on a day-to-day basis.
Yes, so let's talk about that. I've got some money.
Okay.
This is really hypothetical, but say I were to have some money and I want to maximise my savings. What should I do then? Because it seems like everywhere at the moment, interest rates are just being slashed. I mean, I got a letter the other day saying mine was going down to 0.0, whatever it is. So how can I maximise my savings?
So there are several websites out there that daily trawl the internet or trawl the banks and building societies and work out where you're going to get the best rate. So as I said, these rates change often daily because they compete with each other for your money, because how they work is they will lend your money out to someone and get 5% from them, and they'll pay you 1% and they make 4% difference. That's the very crude way of how a bank or building society works. It's a little more complex than that, but that's the basic premise. So really what you want to do is go, what am I saving for, firstly? So if you're saving for retirement, for example, which is many, many years away for you and I, then really you want to consider saving into something like the stock market, which is going to give you better returns over the longer term than saving in cash. Well, if really you're going to save for, say, a year or 2 years, putting it in the bank or building society when you know the value is going to still be there at the end of the day and it's not going to fluctuate, but you're going to get some interest on top. Simply searching for the highest interest rate paying account is the best thing for you.
So let's talk about the stocks and shares thing, because that would interest me. So if you're saving for retirement and you say put it into stock markets, is that not a bit risky?
It is. Well, everything has risk with it. I mean, leaving it in the bank is not risk-free in itself. Your money is going down year on year. So that's what a lot of people don't appreciate when they have money in the bank and with NS&I, is that inflation is the silent risk. So inflation is the value of your pound year on year. And the way I always like to describe inflation, especially to people that are far older than I am, is in very simple terms, how much was milk back in, say, the 1980s versus how much is milk now? How much was bread then? How much is it now? And if you consider it may have been 4 or 5 pence, but now it's £1, that there is inflation summarized. So it's buying the same thing, but that thing over time has got expensive because the purchasing power of money has basically decreased.
So what you can get for your money is going down.
Yes. So if inflation is 2% and interest is 1.5%, you're losing 0.5% each year.
That's a scary thought to pause on, but we've got to, because McFly awaits. I've got a question for you after this. Don't go anywhere. So Felix is still with us because I wanted to ask him another question and we didn't have time. Felix Milton, chartered, oh, hang on, I've got it here. Chartered financial planner.
Thank you.
Yes. I want to ask you about interest rates.
Yes.
So what's the current Bank of England interest rate?
You mean the Bank of England based rate?
Yeah, the one that they always report on every 3 months in the news.
Well, so the reason they report, so the Bank of England base rate, what it fundamentally does is basically, it's the rate that the Bank of England want to encourage either spending or saving in the economy. So they will, and the Bank of England base rate controls inflation. So that's what we were talking about earlier, the value of pound on year. They have a target of 2% of inflation. They don't want to go above it and they don't really want to be below it. They want that to be the target. So,
sorry, just quickly then. So why don't they want to go below it? Because if inflation means that we get less for our pound,
yes,
surely we don't want inflation.
Well, it's not quite as straightforward as that, because inflation generally shows the economy is growing a bit. Right. So if goods are getting a bit more expensive and people are still buying them, naturally there's been some cost price inflation, and that's one of there's lots of factors that feed into it. But basically, the Bank of England wants to ensure there is some inflation because it means the economy is ticking over nicely.
Got it.
So they use base rates to control what is happening with your pound, basically. So they want to make sure that the banks are either encouraging you to save or encouraging you to spend. So at the moment, they're trying to get you to spend. So because if you go out and spend some money and buy some things, shops make profit and that profit goes back into the economy and so on. So that's the theory behind it. But the reason you don't get the rate that the Bank of England set is because that is the Bank of England base rate that the banks adhere to. So really, the banks want to encourage you to get a little bit of markup on top of that. So you will usually get the base rates plus something else. Because why would they not give you the base rate? But so typically that's how they adhere to it. And it's the rate typically the banks can borrow money from the Bank of England themselves and so on. So
the rate at the moment is it 0.75?
It's
that what it is at the moment?
0.5 I think at the moment, and I think they're thinking of cutting it again back to
okay.
0.25, which was the historic low. But they keep umming and ahhing about it because some on the Monetary Policy Committee want to reduce it again, and others want to leave it as is, and some want to even increase it. So it's a bit in the air at the moment as the economy is coming out of Brexit has happened and what's going to happen going forward, and they're trying to second guess what they want to do with the base rate.
So the Bank of England base rate doesn't have very much to do with the interest rate I get on my savings then?
Well, it does. It will be part of that interest rate, but it's not paid by the Bank of England. It's paid by the bank, and the banks will set their rates based on that because it's setting money in the global currency markets.
Can they do whatever they like? Can they set the savings rate?
They could, but it wouldn't be in their interest to set it much higher or much lower than the base rate. So they all set it pretty close to that and a bit on top.
Right. Okay.
But that generally is what happens with the base rate.
So if you're on 0.5% base rate,
yes,
you're unlikely to see 6% interest on
yes,
your,
you'd probably see maybe 0.6 or 0.7 because it's the wholesale costs for the banks to borrow on the money markets.
There we go. I've got one more question for you, which is about ISAs. Now, there was a little bit of a panic last year.
Yes.
About the Help to Buy ISA, and it was running out, and everyone had to get one of these before they stopped doing them. If you haven't got one, it's not the end of the world, is it? Because there's now a new thing.
There's the Lifetime ISA. So that basically is the predecessor of the Help to Buy ISA. And what that means is that you can save either for a house or for your retirement within it. So it's better than Help to Buy ISA already in that respect. You have to have the account open for a year until you can get the bonus to go towards your house. But for every £4,000 you put in, the government will put in £1,000. So that's the limit you can put in. So if you're saving for a house, it's a great way to get money from the government for nothing, and it's a 25% uplift on anything you save. So it's a win-win.
So is the lifetime ISA actually better than the Help to Buy then, in your opinion?
In my opinion, it is, yes, because if you don't buy a house with it, you can leave it for your retirement. Whereas the Help to Buy ISA eventually had to go into buying a house.
You had to buy a house.
So, I mean, you could give up the bonus and not buy a house, but what's the point in that? Whereas if you keep it, you retain the bonus and you get the growth on that bonus until your retirement.
And you'd get the bonus in your retirement.
Exactly, but that's the point. If you take out before then for anything else other than buying a house or your retirement, you're going to lose that bonus. So that's the risk.
That is the risk. Felix, thank you so much for staying on and talking money with us. Felix of national radio fame, by the way. I mean, we're grateful for his time because he's a bigwig now. And you're also in the paper tomorrow.
In theory.
One of the papers.
Hopefully.
Out there somewhere, one of the broadsheets. You're going to be in it, talking finance. And you've also got a website as well.
I
and
do.
Some social media
But
channels.
it's got not much on it yet. So I've got Finance with Felix on my Instagram, which hasn't yet got anything on it, but hopefully I'll post things soon. And I hope to give financial tips and just general hints on it. But I haven't really started yet. But if you could follow, that'd be great.
Wonderful stuff. And you'll be back with us at the end of next month.
I will.
Lovely. Felix, thank you very much indeed.
Thank you.